Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. Following Powell's dovish speech, which swiftly elevated gold prices to nearly 2030, the strong uptrend has slowed. I'm not surprised, actually, as Powell's unexpected remark caught the market off guard emotionally, with no anticipation of such an early positive response on rate cuts. The 30 basis point contraction in two-year Treasury yields quickly drove up gold prices. Investors are now bullish on gold, adjusting risk exposures ahead of the US Pce inflation data on Friday early morning and also before Christmas. As usual, let's firstly examine the daily chart of gold against US dollar. Last Thursday, gold closed high at $27.3, a rise of nearly $48 per ounce. The surge continued into the next day, briefly touching $20.48, matching early April and May highs. Unfortunately, prices didn't break this resistance, leading to alternating long and short positions within 2048 to 2014 range, the latter being the 23.8% Fibonacci retracement level of the October to early December rally and close to the October 27th high. With neither side clearly dominant, I see 2014 as the week's pivotal level. For upward movement, 2048 remains a critical resistance. A substantial breakthrough could target the 2075 to 2078 range. The downward focus remains around the significant 2000 mark and also the 1982 supply zone. Behind gold's consolidation are two factors. From the selling perspective, Fed officials moderated the market's aggressive pricing on rate cuts. New York Fed President Williams countered Powell's view on the day after the FOMC meeting, deeming it premature to consider rate cuts, and Atlanta Fed President Bostic also indicated two potential 25 basis point cuts in late 2024 instead of 3 cuts suggested in the dot plot. Their remarks led to modest short selling in the US bond on Friday, with two-year yields rising 6 basis points, providing a breather for the dollar, up by 0.6%. The slight increase in treasury prices and also the US dollar led to a gold drop as an alternative asset. However, rate cut expectations have been priced in before official statements, leaving the market unshaken in either direction. And from the buying perspective, gold as a key safe haven asset has regained importance amid emerging geopolitical conflicts. Houthi attacks on ships in the Bab al-Mandab Strait have heightened oil price risks, compounded by major European shippers and BP halting operations in the Red Sea. Approaching Christmas, investors prefer buying gold to protect portfolios from potential escalations during low liquidity trading. And meanwhile, 10-year US Treasury yields stabilize below 4% at the moment, with real rates dropping from about 2.05% to 1.72% in a week, positively influencing gold prices by reducing opportunity cost. So overall, the gold market is in a consolidation phase with frequent shifts between bulls and bears. Fed officials' moderation supports selling, while looming geopolitical tensions and aggressive rate cut pricing offer buying reasons. Yet, there is no strong push for a trend in gold prices, with both sides in a stalemate. The US core Pce inflation at 30 minutes past midnight on Friday, closely watched by the Fed, becomes crucial. The market expects the November US core Pce price index to slightly off to 3.4% year over year. If Pce data continues to show signs of easing inflation, it could support international gold prices. Conversely, a reversal of the inflation slowdown trend could put pressure on gold. And additionally, if no more Fed officials support Powell's stance before Christmas, gold may further crack downwards, making the market more cautious and likely continuing to consolidate in the short term. So that's all for this week. Stay tuned with Pepperstone for more insights and updates. Happy trading and happy holidays!